Take a look at this price action, and you will see a downtrend. You just know it from looking at it. But that doesn't help a lot because there are multiple ways of analyzing this price action. Some might see that the swing points of the highs are lower, and also the swing points of the lows are as well lower. So they kind of see this as a downtrending channel. So if we are at this high, there are only two options. In one option, the market keeps respecting this channel. So basically, it rejects down from here and targets the lower level of this channel, essentially just staying inside of this downtrend. And on the other option, the market breaks out of this channel. After a break, a pullback often happens, and usually they plan buy setups on the retest of the channel in hopes to take the market higher. Because if you analyze the price action this way, this channel is the most important thing you're looking at. If it breaks the downtrend channel, then it means that we now enter into an uptrend, and a similar thing should happen, but for an uptrend channel. So let's see how that plays out. We get a break to the upside out of the downtrend channel. So you would now expect an uptrend. It also pulled back, retested, and then bounced to the upside. When they see this happening, they're rushing buy setups because they now expect an uptrend since the downtrend channel has broken to the upside. But what happens next is that the price pushes back down and hits their stop loss, basically losing the setups. Now there is also another type of analysis, which is the one you will see on this channel. It's the structural analysis of the trend. We do that by first having an idea about the recent direction of the price. You will often see that I do that by drawing these lines because it's easier to see the swing points. And what we see here is that we initially had a push from a low into a high, then from that high, the price pulled down and broke below the last low. A break of the last low is of course a lower low. A lower low is a swing point of a downtrend, and usually what comes after a lower low is a lower high. A lower high forms the moment the market pulls to the upside, but is not able to break the last high, and so it does form a lower high. But that lower high becomes valid only when the price breaks the last low into another lower low. When the break happens, we know with certainty that the last high was in fact a lower high, and it's from that high where we got that downside push that continued the downtrend. Downtrend continuation is basically a market that is constantly repeating this pattern of lower highs and lower lows. Then from the last lower low, similar as I said earlier, after a lower high should usually come up next. And a lower high is again a pullback to the upside. And if we come back to the first analysis for a bit, that's when this upside push broke out of this channel. Many would have expected an uptrend. But this break of the channel doesn't matter at all, because this push to the upside was really just a pullback after a lower low. So the market can create a lower high, said by its name, is a high that is lower than the previous one. A lower high will often end on a supply or resistance level that is taken from the last high. So we look at the last high, and the supply is the last upside candle before the market started to go down. That's how you identify a supply. And we see that this upside pullback ended inside the supply. It's there where it topped and started to drop back down, structurally from a lower high. A lower low should be coming up, so that means that it should break below the last low. That's how a lower low is created, and that's also what it happened. It's only about holding these lower low swing points with lower high swing points, which is what happens during downtrends. That's why the planning for the setup in such situations are sell setups from supply levels, with the stop loss above the supply, since we do not expect a higher high, and take profit below the low since we expect a lower low. So you see the targets have some logic behind. The only thing you must keep in mind is to not look for extremely high risk-reward ratios. You will see on this channel that most of the setups are taken in the 2-to-3 ratio, rarely above and rarely below. So that's why it's not enough to know that this is a downtrend, because you can get two different results from two completely different ways of reading the price action. Here it's the other way around. From a straight look at this market, we see an uptrend. Some see the uptrend as a channel that connects the highs and the lows, just like we've done on the last market. And on the last candles, we see that it's sitting on the bottom of the channel. It has two options. It can bounce to the upside from here, and you will see many buy orders sitting on these levels. And there is also the other option, where we get a break to the downside of this channel. In this situation, some will wait for a pullback to the upside to basically retest this channel, level where they usually enter with sell setups. The reason they look for sells is because they decide the trend based on this channel and not based on the structure of the highs and lows. And let's see what happens. So it actually broke the channel. Now many will rush with sell setups hoping for a retest of the channel. And now let's see how the analysis of the structure would be done. Lately, we have this price action of what it looks to be an uptrend. So far, on both ways of analyzing the market, both are seeing an uptrend. The uptrend has a price action with higher low swing points that are then followed with an impulse to the upside that breaks the last high, constantly forming a higher high. What holds the uptrend is the constant repetition of this pattern, because we see that from this higher high, we got a pull to the downside that ended on a low. This low ends up being higher than the last low. In other words, that's a higher low. And after a higher low on an uptrend, a higher high should be coming up next. The higher high is a break of the last high. And to break the last high, you need the market to push to the upside above the last high, and that creates the higher high. Now after a higher high, as long as the uptrend keeps holding, the next swing point should be a higher low. That's seen as a downside pullback that ends above the previous higher low. And after a higher low, a higher high is the next swing point. That's seen as a push to the upside that breaks above the previous higher high. Then from this higher high, what happened next is that the market aggressively started going down, which eventually broke below the previous higher low. This turned it into the first lower low formation. Now when we had a higher high, which is a swing point of an uptrend, but then the next swing point is a lower low. That first lower low signals a trend change from an uptrend into a downtrend. A downtrend has swing points of lower lows, which we already have, that are then followed with lower highs. And as you've seen on the last market, lower highs are upside pullbacks that are not able to break above the last high. But instead, the pullback needs to end below the last high before eventually continuing the downtrend that it just started, and a continuation of a downtrend is basically just a price action that keeps forming this lower high and lower low pattern. So if we expect an upcoming lower high, a lower high means that the next high can't break above the previous high, so the next high must end below. But here, it's where these two types of analysis completely give out two different opinions. On the first analysis, after the market broke the uptrend channel, you expect a downtrend to be happening. A downtrend starts with an upside pullback, and the target for this pullback would be a retest of the channel, which would open this sell setup, and then hopefully a downtrend continuation into breaking the last low. But on the structural-based analysis, if the market actually goes to the upside to retest the channel, that means that it also breaks above the last high. And structure-wise, if a high breaks into a higher high, that means that the market enters into an uptrend. So yes, this sell setup would probably get opened, but because the market might enter into an uptrend, this setup would have increased chances of getting stopped out. And on the approach of the structural-based analysis, since we're expecting a lower high, just like we've done on the previous market, a lower high should often end on a supply zone that is taken from the last high. So we look at the last high. The supply is found near the last upside candle before the market started going down. This is not an exact level. It's only an approximation. Some will also consider the supply as the last candle before the market started dropping. Even if it's a bearish candle, it doesn't matter that much and will likely not make a huge difference. Try to test both and see which one works best for you. The setup is planned with a sell short from the supply, stop loss above the supply, which also should coincide being above the last high since we do not expect a higher high on a downtrend, and take profit below the last low on an expectation of a lower low. Right now it's pulling back to the upside. It hits into the supply. Here, even if you would take the last bullish candle before the impulse, it still hits the supply, so as I said, it likely won't make a big difference. But what's important is that after hitting the supply and opened the setup, we see how it quickly rejects down from the supply and keeps holding this bearish pressure, causing a break of the last low, creating a lower low which closes the setup on the take profit target. So keep in mind, it's the structure of the high and low points what decides a trend. This is a more complex video, so you might need to watch it multiple times. Take your time with patience. Also, if you're interested, you might want to take a look at our program linked in the description, where we do more of what works, so you can find high-quality setups and doing less of what doesn't work, so you don't lose the profits back.